What's good, traders? So before we head on to our charts, it is better we understand that there are structures of the market before we can start trading. Now these structures take three different forms. The first one is a bearish market. This is a bearish structure whereby we see series of lower highs, lower lows, lower highs, lower lows, lower highs. And the second structure is when the market is consolidating. So that is when the market is ranging, not giving you a specific direction as to whether it's going up or going down. And the third scenario, the third structure, where we see the market moving on a bullish trend. So that is where we see series of higher high, higher lows, higher highs, higher lows. So the first high you want to work with is called a high, and we have a higher high and higher low and forms like that. Let's head on to our chart now. So onto our charts, let's search for our higher high and higher low and our lower highs and lower lows. So this is a 1 hour time frame, and to search for this market structure we need to highlight this one. So from this is a low, right? This is a high. So looking at this market structure, we can obviously see that the market is on an uptrend. That is a bullish trend. So this is high, this is high, this is our low, this is our higher high, this is higher low, this is higher high, this is higher low, and this is higher high once this market breaks. So we have our higher high and our higher low. So in this kind of scenario, what do we need to look for before we can trade? We need to look for opportunities for the market to we need to look for opportunities to go long, to go bullish. So we need to expect a scenario where the market retraces back and gives us a bullish opportunity to enter the market. Okay, this is on a 1 hour time frame. Let's go back to the 4 hour time frame. So on a 4 hour time frame, we can see that we can see that the market has been on a bullish trend, right? So okay, let's highlight it. So this is our low right here, this is our higher high, this is higher low, higher high, higher low, higher high. Now the market breaks as if it wants to go low, right? But there's a scenario here that the market obeys before the market push to the upside. So now this is invalid. This is not our higher low, this is our low right here, this is our higher high, higher low, higher high, higher low. Once the market breaks this high here, this one becomes our higher high. So in this scenario, we are just going to be looking for a buy opportunities, right? For most cases, we can also look for sell opportunities, and these sell opportunities can occur while the market is retracing. So on this higher time frame, we see this market as a bullish trend. This market is basically divided into two structures, right? So the first structure is the higher time frame structure that you're looking at. So let's assume that we're trading from looking at this low right here, and we are here. So this is a low and our higher high, higher low, and we want to trade when the market is going down. We want to trade when the market is going down, right? So let's say the market has created a higher high right here, and market is retracing to the downside to continue on a bullish trend. We see this retracement as what our substructure, and this is the internal structure here. So we look for trade opportunities that the market can respect on this internal structure right here, while the market is retracing as a substructure. So the retracement on the bullish trend is our substructure. So this is our substructure here. Let me write it right. So this is substructure. This is our substructure right here when the market is retracing to the down side. So that is our substructure, but this is our, so this is the internal structure right here. Internal structure. All right, so this is our internal structure when the market is going up on a bullish trend on a lower time frame. So on these lower time frames, we are going to be looking for buy opportunities. As you can see from this break of market structure right here, this is a break of the market structure. So this signifies that the market wants to rally to the upside. So we look for opportunities here. So inside an internal structure, there is an internal structure. It depends on the time frame you are using at that time. So let's say now this is a 4-hour time frame. When you go to a 1-hour time frame, we see that this is your internal structure. This is your internal structure. And market coming down is what your substructure. So you look for entries here. As you can see, we can already see a reason to enter here, which is what our fair value gap. So this is a fair value gap right here. You can see our fair value gap right here signifies that the market can respect it and rally to the upside, so thereby creating a bullish order flow. You can see it right here. You can see right here. Now the market is always going up and coming down on a trendy market where it's not consolidating. Now this market respected this fair value gap here too. You can see right here that the market respected the fair value gap right here and rallied to the downside, creating what is substructure. Now this substructure, because it's on a bullish trend on a higher time frame, the market respected this internal structure to move up, and you can see a reason why the market respected it. This is a BC right here, a BC right here. If you don't know what BC is, you can look for the video. You can click on the link and go to where you see liquidity void title. Then we're going to talk about BC and CB there. So you see how market respected this BC. Market respected this BC and rallied to the upside again. You can see another one here. Remember, this is our internal structure. All right, so let's see why market respected this. You see how market respected this BC right here again. So if the market was to come down to this spot again, it might also respect this BC right here. Let's look at it from this angle right here. So let's say you are trading from this spot and you classify this area as what your trading range, right? So this is what your low. This is what you can classify this as your higher low, your higher high. This is your higher high, this is your higher low. This is your higher high, this is your higher low. Now because we are on a 4-hour time frame, we are using that, right? So we want to go down to our lower time frame to search for buy opportunities, since we are on a bullish trend. Now bullish trend now. Okay, so market has created a what? A break of market structure. This is our BMS. Break of market structure. BMS. So we can call it market structure shift. So break of market structure. Now on this note, we look for buy opportunities right here. We look for buy opportunities right here. You can see we have breaker here. So market respecting this breaker after taking liquidity. You can see right here what we talk about liquidity. You can see right here market took out this one, and tapped into this breaker after it created a break of market structure. So market taps into that breaker, and that is one reason for the market to go up, to continue its bullish trend. So market continued the bullish trend and created another internal structure. So this internal structure has a PD array that can be used for the market to rally to the upside after its retracement here. So this is an internal structure. Now there are some elements here which we call PD arrays. Okay, we can see a BC. You can see a BC here. You can see a fair value gap. You can see a small fair value gap here. So this BC now, or this BC here, this is a fair value gap also. So you can see if you are at this spot and you want to continue the bullish projection of that market at this time, you can just draw your BC or your fair value gap and expect market to tap into it. As you can see, there is also a mitigation block right here. You can see it. So a mitigation block with a BC gives you reason for you to enter the market and continue the trend. So you can see, so when you continue this trend, you can see how market can just rally to the upside. You can see how markets rally to the upside, tapping into that BC and mitigation block. Alright, so let's delete this and let's go back to our internal structure. So this is our internal structure now. Has elements, has PD arrays that market can respect when market retraces back. So these PD arrays that we can find here, number one, our untapped BC. On a bullish trend, when you see a fair value gap on a bullish trend that's going up, so we call that our BC, and on a bearish trend we call it our CB. So this market now sees this BC to be filled up, right, to balance that price. So market rallies, retraces to that spot, gives a break of market structure right here. Let me show you where the break of. So after market rallies into that zone, filled it, there's a break of market structure right here. You can see it after this. Okay, let's go down to the 30 minutes. So we are down to our 30 minutes. All right, so we are down to our 30 minutes. We can see how markets feel that. Okay, this is where we are here. This is where we are. You can see how market rally to the upside, right? Break of market structure. After creating this break of market structure to the upside, you can see market taps into a zone here, which is another fair value gap, another BC. You can see it. Market taps into it and goes and rallies the other way. Now there is an untapped BC here also. You see how market taps into it? Market taps into it from this substructure here. Market taps into the internal structure. So giving you a break of market structure. After this break of market structure right here, you can see how market while it's breaking this high here and not creating another low. As you can see how market is creating lower highs and lower lows on. You can see how market is creating lower highs and lower lows. Let me search for this stuff again. Where is this? You can see how market is creating. This is a low, this is a lower high, lower low, lower high, lower low, lower high. You can see a lower low, lower high, lower low. You can see how everything is synced, and market stops creating a lower low after creating this low here. Market is supposed to create a lower high, right? After this lower high, market did not create any lower low again. So now market taps into this BC here, and that is the end of the substructure. So let's target it. So that's the end of the substructure here. So this is a BC on a high time frame. All right, let's go back to a high time frame, which is our 4-hour time frame. You can see how market taps into this space, this BC. Market taps into it, then taps into this one, this box here, creating a break of market structure to the upside. Now market rallies down and taps into it. After tapping into it, you can just buy. After you go long from this spot, you can expect market to reach this previous high, creating what? Creating a higher high. You can see how beautiful markets rally to the upside. So that is what we can we should understand about basic market structure and how the market respects its internal structure. So price is fractal, meaning that what goes in the higher time frame also goes in the lower time frame. It just happens in different forms. So let's do a recap. So when you are using a higher time frame, let's say a daily, you see your higher highs and your higher lows, your higher highs and your higher lows. The first things you need to trade, or the first type of trade you need to put in mind, is a bullish kind of trade. So you need to look for reasons for you to go long, for you to buy in that market. So when the market is retracing to the downside, you either don't trade or you stay careful with your trade and you place your trades with your higher time frame in mind. That means you take your bearish trades in a bullish trend carefully. You have that bullish trend in mind, because the bullish trend is what controls the lower time frame. So when you see a bullish trend on a higher time frame, that is what you should trade with in mind. That is what you should put in mind. So when you start trading against the market, you should be careful, because the market can start rallying to the upside very fast, very quick, and it gives much more rates to reward when you're trading with the market order flow. So as you can see, market is respecting some things here. Market is respecting, see this CB here, this is a CB, right? Market respected this CB right here, but remember, this is a bullish trend, so market cannot respect it for long. So market respected this CB here by tapping into it and going down. Now created another CB, market taps into it and goes down, but market did not pass this low. Why? Because it's on a bullish trend. Remember that on a higher time frame, market is on a bullish trend. You can see market did not break this low right here. Market did not break the low right there. So market is on a bullish trend. So on a bullish trend, expect to trade with the market order flow, so you don't get eaten up by the market. As you can see, market respected this BCA, market respected it and moved to the upside. So when market tries to retrace to the downside, there should be things you should look out for. Is it this BC right here? Is it this BC right here? Market can as well respect this BC, and you look for break of market structure to go to the high, so go to the opposite direction and follow the higher time frame order flow, which is the bullish trend. Well, while market is coming down, have the bullish trend in mind. So when market comes down, except market breaks this low, right here, that is when you should now be looking for confirmation that the market wants to rally to the downside. So let's see something like this. When market breaks this one here like this, so market breaks this, where is this? How am I looking for this stuff every time? So let's see, market breaks this one right here. As market breaks it, creates a lower high and a lower low, then just know that it does not create a lower high, it does not create a high that is higher than this one here. So market breaks it, when market breaks this one, there could be a fair value gap at this spot right here. There could be a fair value gap right there. You can see there could be a fair value gap right here. That would validate the market going bullish. So when market is trying to retrace to the upside, just know that that could be your substructure. But having it in mind that the market is bearish on a higher time frame helps a lot, because when you go with the order flow of the higher time frame, you can even swing it, because it can retrace, but you don't have to be scared that the market is going to take you out, because when it retraces, you know that it's going to go with the higher time frame order flow. So it's more like trading a top down analysis. So when you see a higher time frame bullish market, follow the higher time frame bullish market. We talked about our trend liquidity. Look at liquidity on a bullish trend before markets rally to the upside. So money must be taken before it follows that order flow. So let's see the money that was taken right here. So as you can see, we said there was a BMS, which is break of market structure right here. This is a BMS. Sorry, this is a BMS. All right, so this is a BMS. Market broke this high right here, so it's no more going on the lower low or lower high. So market broke it, and coming back, you can see that there was liquidity here. Market took this liquidity. After market was done taking this liquidity, taps into the fair value gap here. That is 2 PDRAs already. Fair value gap here. Market rallies to the upside. You can see it. You can see how market rallies to the upside, giving you series of opportunities to enter the market again. Fair value gaps are actually a powerful PDRA. You can see fair value gap here. Market taps into this fair value gap. Market taps into this mitigation block right here, coupled with what? Fair value gap, which is on this case a BC. You see market taps into this fair value gap right here after taking this liquidity here, after taking this liquidity here also. You can see it. All right, this is a bullish trade. Now you can see liquidity right here, right? This is liquidity, and market retraces down, taking this liquidity out also. Let's highlight all the liquidity here we can find. And after market takes that liquidity, you can see a BC, a fair value gap here. You can see a fair value gap here. What the market do? Market taps into that fair value gap. You can see it taps into the fair value gap and rally to the upside, following that bullish order flow. Let's see more. Alright, so this is a liquidity here. This is liquidity here. You can see this liquidity was taken out, and we have what? Our breaker. This is a breaker on a lower time frame. This is a breaker on a lower time frame. Alright, so this is a breaker on a lower time frame, and we have what? We have three things actually. We have our liquidity, we have a breaker, and we have a fair value gap here. And market rallies down, taps into it, and goes up. So all this liquidity you can find here, they are called our trend liquidity. So if you don't know about trend liquidity, you can watch the video on the channel. So that is talking about our liquidity, our protected high and protected low. So this is now a protected low because the market does not need to take out this low again. Why? Because it has taken this liquidity. So you can see this trend liquidity on a bullish time frame. You can just take your trade. Okay, we can see one trade here, second trade here, this is another trade here, and so we can see that there is a fair value gap here, right? I didn't highlight it. Fair value gap. Market took out the liquidity, taps into that fair value gap and rally to the upside. Took out this liquidity, taps into the fair value gap to the upside. Okay, let's see. Okay, this one too took out this liquidity, taps into this fair value gap, rally to the upside. We'll talk more about this on our strategy creation. When we are creating our strategy, you can see this is the liquidity also. This is liquidity, but on a lower time frame. Liquidity. This liquidity already covers this fair value gap right here. So this one also, let's search for more liquidity. And all right, okay, this is one here. You can see a fair value gap here. Fair value gap here. You can see a fair value gap here. And what can you see? You can see liquidity here. Alright, so this is our trend liquidity. After using this trend liquidity, you can trade with the order flow, with the bullish order flow of the market. While the market wants to retrace, it gives a signal. How does it give a signal? It creates, on a bullish trend, it creates a market structure shift. It creates a market break of market structure, as others call it. You can see we can also expect a break of market structure here because markets took out. Let's go to a 15-minute time frame or a 5-minute time frame. Let me show you the liquidity I see here. So this is on the lower time frame, which is our 5-minute time frame. You can see that the market takes out this liquidity and what taps into this fair value gap right here. Alright, so you can also see it here too. This is the BC. Market takes this one, taps into it and rally to the upside. So you see how it is. Not so easy but simple. Alright, so that is more like searching for trades. So you can search for this kind of trades on a bullish time frame. You can see this one also. The market tap into this fair value gap? Well, we can put it there that market taps into it. Let's be sure that market taps into this fair value gap. All right, so voila, you can see market taps into our fair value gap right here. So let's expand it more. You can see how market taps into this fair value gap here. Just a little tap of that wick, and prior to that tapping, you can see that there is the liquidity that has been taken out here. The liquidity that is taken out here, and you can see a breaker right here. You can see a breaker right here. You can see a breaker right here. If you want to be sure, you can use this breaker. You can see that it has a breaker or mitigation block right here. You can see it. Then you draw it to your wick, and here we have a trade. After market taps into your fair value gap, we have a trade, and this trade can take from 1 to, depending on your previous high. Let's see where our previous high was on a higher time frame. Okay, our previous high is quite far. Oh, our previous high is quite far, so we can just take it from 1 to 3 or 1 to 4. You can see it 1 to 3 and 1 to 4. Then we have a trade. And once this market does not create a high higher than this one, that is, once this market does not create this high, then we should be expecting a bearish trend very soon. So if the market stops here, does not create a high, and goes down, breaks it, then we could also project a bearish scenario, because the market broke what? The market broke this low here. We have a market structure shift. See, just beautiful like that. And yeah, so that is all about our trend, our internal structure, our trend, and trend liquidity. As you can see, this is your trend liquidity. Let me show you the last setup. Okay, I took this setup too. Let me show you this last one. You can see that there is a fair value gap here, right? Let me show you this one. Let me show you. We have many. Okay, so this is a fair value gap right here. This is a fair value gap right here. This is a liquidity. Market took this one, taps into the fair value gap, rally to the downside, right? So this is the last one I want to show you right here. This one is on our substructure when the market is going down. You can see that we have a fair value gap right here, right? Where is the fair value gap? This is our fair value gap right here. And what the market do? Market sees liquidity resting above here, which is the money. The funds must be transferred. So the market taps into this fair value gap, takes out this liquidity, and rally to the downside. The same thing happened here. There's a fair value gap here that has not been filled up yet. This is a breaker, right? And what the market do? Took out this liquidity. You can see it right here. Taps into this fair value gap and rally to the downside. You have yourself a trade. You have yourself a strategy already. But we'll be dealing more on of small strategies on our next strategy video. All right, so don't forget to like, subscribe, and share, and comment what you think if this is your strategy also. All right, peace.